Ira, I want to come in, though, first with you. Your read on what's happening in the U.S. rates market, in the global rates market, and how connected they really are, or not.
Well, they're extremely connected, and I would say that one of the big reasons why we do have this rise in 30-year U.S. Treasuries is there's alternatives now for people to buy other bonds. So Japanese government bonds, when you hedge it back into certain currencies, winds up yielding more than U.S. Treasuries. So now there's the Treasury yields have to compete with yields from other countries. So that creates this very high correlation between a lot of the developed market government bonds. And a lot of the things that you just said, Carol, things like fiscal issues, not only here but abroad as well, right, in Japan, Germany, the UK in particular now, right, you wind up having the situation where people are worried about the long-term health of these developed bond markets, and that's all feeding in to this frenzy of I'm not going to say it's long and selling, because I have yet to meet anyone and talk to anyone who's actually selling, but they're not necessarily buying, which means that the governments who are selling just have to attract people by issuing at higher yields.
Davide, let's bring you in here. Do you want to build on that?
Yeah, because interestingly, the competition is coming also from the corporate side now. That's what's happening with the AI sort of financing wave, right? So we're seeing like a lot of corporates issuing tons of debt on the long end of the curve. So essentially long-term maturities, which is providing competition to the long end of the treasury curve. Essentially, portfolio managers have more to choose from, and that leads to sometimes selling treasuries to buy corporates.
What's the comp in corporate bonds that we've seen like this? Is there a comp?
I think it is unprecedented, quite frankly. We are seeing record levels in terms of issuance. We are at 1.5 trillion only in the investment grade market so far, and that's already 30% more than last year. There's wide expectations of
30% more than last year.
Yeah.
Go ahead.
No, there's wide expectation of essentially record issuance levels this year, more than even in 2020 when rates were very low. So yes, it's unprecedented.
I don't know, Ira, so, all right, if they're not selling but they're not buying, that's still a problem.
Yeah, it is, and I just want to go back to say that in terms of the long investment grade corporate bonds, which are competing, and certainly the AI issuance and other long bond issuance is certainly competing at some level, and there are people who want to hedge their interest rate risk, so that is people selling long ultra bond futures or shorting treasuries against it as well. We have seen, though, this type of issuance as terms of percentage of the market before. If you go back to the telecom boom in the late 90s, early 2000s, you saw a lot of long-term corporate bonds. But I was a corporate bond strategist, several decades ago now, I hate to say, but
we've all been doing this a long time, Ira. We get you. We get you.
Yeah. So when you have a lot of issuance, and particularly when it changes quickly, right? So in terms of people selling a lot of 5- and 10-year debt, and then suddenly they decide to go out the curve because they either have a funding need to go out that far, or they don't want to have a maturity wall in a couple of years. That can change the tone, certainly. But when it comes to treasuries, it's not only AI, right? We have to make sure that we understand that there's a multitude of factors that are driving this that all happen to be coming together at the same time, including things like Kevin Warsh, not necessarily having the confidence of the market. So that has to increase risk premium. And you've seen that throughout most of the Treasury curve, in particular the 10 and 30-year part of the curve, where you've seen those yields rise just on the back of people not knowing if the Fed's going to be able to control the economy the way it used to.
Ira, what do you blame the most? Is it Mr. Warsh? Is it the AI issuance? Is it what do you blame the most here?
There is no most.
Okay.
So it's a little bit of everything. And here's the thing, like AI, the AI story wouldn't matter if you didn't have these other things going on, right? People would just be like, okay, it'd be worth 10 or 12 basis points, right? It would be like a blip and a couple of days of reasonably sized moves. But the fact that you have now, fears of the fiscal situation in the UK, you have fears about, the BOJ raising rates even further and seeing their yields above 4% for the the first time in decades as well, right? All of those things are feeding onto this, and then you add on to that the AI supply story, and it just makes it much worse.
Hey guys, I want to bring into the conversation. Ed Yardeni and his team put out a research note. Of course, he coined the term bond vigilantes, and so we listened to what Mr. Yardeni has to say. In the note, it said, "We aren't pushing the panic button. However, we are closely monitoring whether the bond vigilantes might do so. We are sticking with our view that the U.S. bond yield should continue to trade in a normal range of 4 to 5% without causing any adverse consequences for the economy and corporate earnings. Nevertheless, now that the yield is approaching the top of this range, we are monitoring the activities of the bond vigilantes more closely." We've been here, I feel like, Davide, before. We've talked about the bond vigilantes. We all get crazy, and then we settle down. Is this just a case of watching, or are there signs that there is a problem and world get ready for higher interest rate costs across the board?
Well, I mean, like the push higher in risk premiums is across the board. So in that sense, we're seeing bond vigilantes also in the corporate bond market, where essentially investors are asking for higher spreads and higher returns on the on corporate bonds. We're seeing investment grade bonds basically trading at junk level yields. So yeah, the push higher is across the board.
That's a sign,
yeah.
right?
Well, it's a sign of investors demanding more because they expect so much supply, essentially, right?
Yeah.
I just can't help but turn back to the backdrop of the Fed. And, Ira, you mentioned just kind of the confidence of the market in the new Fed chair. Could you unpack that a little bit? Because, I think a few of us have lived through a different Fed chair changes. Why would this one be any different than the others?
Well, I think because the change in communication wasn't incremental at all, right? It wasn't just a little bit of a slowdown. We're going to reduce the amount of forward guidance we give, and we're not going to, we're going to give just a little bit less information in the statement. Look, the Fed's post-meeting statement went from about 400 words to 100 words in one meeting. And
but were they good words? 100 good words?
No, they didn't say. It doesn't say anything now, right? It has no forward guidance. It has no reason of expectation. And here's the thing: like Kevin Warsh, I think so far has kind of misread what the market wants and needs. And yes, he has the communications task force. I put out a big deep dive report on that yesterday, where we're looking at all of the task forces, and the big one is communications, because so far Kevin Warsh hasn't given the market any indication of what's coming next or what will come next given any given economic outcome. So unless you do one of those two things, right, either give forward guidance or say, okay, here's the 5 things that might happen, and we'll do this, that, or the other thing depending on which outcome occurs.
Right.
He has to do one of those two things, and he hasn't. So the market's confused, and we price in higher risk premium, like the other guest mentioned.
Okay, so a lot of uncertainty about certainly the Fed chair. We need a little bit more specificity. One thing we know real quickly, 20 seconds, Davide, we're going to get more credit or bond issuance from all these hyperscalers and so on and so forth. It's going to keep coming.
I mean, it's relentless, yes. And we're looking like, $2 trillion over the next couple of years in terms of estimates. So yes, just in the investment grade market. So it's a lot to come, yeah.